Imagine waking up tomorrow to see the stock market down 15%, your portfolio bleeding red, and headlines screaming panic. The feeling of helplessness, the rush of anxiety, and the pressure to act immediately can overwhelm even the most experienced traders. But before you hit sell, it's crucial to understand that market crashes rarely happen without warning. They leave subtle signs, patterns, and signals that, if recognized early, can help you protect your wealth, reposition your strategy, and even find opportunities amidst chaos. The first signal to watch is extreme market euphoria. When stocks surge relentlessly, financial news is filled with stories of new millionaires, and everyone you know is buying the dip, that's often a warning. History shows that these euphoric peaks are usually followed by sharp corrections because markets cannot stay irrationally overconfident forever. Next, pay attention to divergences between economic indicators and stock prices. If unemployment rises, GDP growth slows, or consumer confidence drops while the market continues to climb, it's a red flag. The disconnect between real-world fundamentals and market valuations often precedes a sharp pullback. Another critical signal is unusual trading volume and volatility spikes. When markets suddenly experience extreme volume swings without major news, or volatility indexes jump dramatically, it indicates nervousness and uncertainty creeping into the market. Traders often underestimate these subtle tremors, but they are early warnings of potential instability. Finally, don't ignore the behavior of institutional investors. Large funds, hedge funds, and major banks often have access to information and trends that retail traders don't. If you notice unusual selling pressure from these institutions, sudden shifts in bond yields, or changes in market sentiment reports, it's a sign that the smart money is preparing for turbulence. Understanding these signals doesn't guarantee you'll predict the exact bottom or top, but it equips you with the foresight to make smarter, calmer decisions when fear spreads like wildfire across the markets. So now that you can recognize the warning signs, the next question is, what should a trader actually do when these signals appear? The first and most important principle is risk management. No matter how confident you are in your analysis, preserving capital is always priority number one. This means reviewing your portfolio, tightening stop-loss orders, and making sure you're not overexposed to highly volatile sectors. If you're heavily invested in speculative stocks or high-growth tech companies, it might be time to reduce your positions and rebalance into safer, more stable assets like bonds, dividend-paying stocks, or cash equivalents. Another key strategy is diversification. A market crash doesn't impact all sectors equally. Historically, defensive sectors such as utilities, consumer staples, and healthcare tend to hold up better during sharp downturns. By spreading your investments across these sectors, you create a buffer that can reduce portfolio losses and provide liquidity to seize opportunities when prices inevitably rebound. One of the most overlooked approaches is staying unemotional. Panic selling is the fastest way to lock in losses. Market crashes trigger fear-driven decisions, but disciplined traders understand that volatility is temporary and that opportunities often arise in chaos. Keeping a clear head, sticking to your trading plan, and avoiding impulsive reactions can make the difference between losing everything and strategically repositioning for future gains. Additionally, consider hedging strategies. Using options, inverse ETFs, or other instruments to offset downside risk can protect your portfolio during sudden drops. While these tools require careful understanding, they are powerful shields against unpredictable swings. Finally, this is the time to observe, learn, and plan for the rebound. Crashes create opportunities for long-term investors who are prepared. By identifying undervalued assets, tracking market behavior, and gradually re-entering positions with a calculated approach, traders can turn periods of fear into moments of growth. Remember, the market doesn't just fall, it always recovers, and those who act thoughtfully rather than emotionally often come out ahead when the dust settles. Now let's get into the specific actionable steps traders can take when the market shows crash signals. First, start by conducting a thorough portfolio audit. Identify which positions are most vulnerable to a downturn and which are defensive. Trim high-risk investments, lock in profits where possible, and make sure you have adequate cash reserves to cover unexpected needs or to capitalize on bargains when prices drop. Second, focus on gradual repositioning instead of abrupt moves. Selling everything in a panic can create long-term regret, especially if the market rebounds faster than expected. Instead, use a phased approach. Reduce exposure to the riskiest assets, move funds into safer vehicles, and slowly build positions in undervalued opportunities. Third, use technical indicators and market signals as confirmation, not the sole driver. Moving averages, RSI, MACD, and volatility indexes can help confirm that a correction is underway, but they should always be considered alongside fundamentals and macroeconomic conditions. Fourth, be mindful of tax implications and transaction costs. Frequent trading during volatile periods can trigger capital gains taxes and high fees that eat into returns. Planning your trades carefully ensures that your decisions are truly strategic rather than reactive. Another important step is to stay informed without falling into the trap of information overload. News headlines, social media posts, and expert predictions can create anxiety and push you toward impulsive decisions. Instead, focus on trusted data sources, monitor key economic indicators, and keep your trading plan at the center of your actions. Lastly, prepare for the rebound phase. Market crashes are temporary, and recovery periods can be unpredictable but rewarding. Have a clear strategy for re-entering positions at favorable valuations, maintaining a balance between risk and potential reward. Avoid the temptation to chase the lowest prices or time the absolute bottom. Disciplined, consistent actions often outperform speculative timing. By following these steps, portfolio audit, gradual repositioning, strategic use of indicators, careful planning, focused information consumption, and rebound readiness, you position yourself to not just survive a crash, but to potentially thrive in the market chaos while others are making costly mistakes driven by fear. The last and perhaps most critical aspect of navigating a market crash is mastering the psychology of trading. Fear and greed are the two emotions that drive markets to extremes, and they are the same emotions that can destroy a trader's discipline if left unchecked. During a crash, it's natural to feel panic when you see red numbers and media hysteria spreading. The key is to pause, breathe, and rely on your strategy rather than your emotions. Maintaining a calm, long-term perspective allows you to recognize that crashes are not the end of investing. They are part of the natural cycle. Another essential mindset is resilience through preparation. Traders who succeed in turbulent times often spend more effort preparing for downturns than celebrating bull runs. Having a written trading plan, defined risk tolerance, and predetermined entry and exit strategies gives you clarity and confidence when volatility hits. Additionally, embrace the opportunity mindset. While losses can be painful, market crashes create the rare chance to buy quality assets at discounted prices. By keeping cash ready and identifying undervalued opportunities in advance, you can turn fear into action that benefits your portfolio over the long run. Remember, no trader can predict every market move, but those who combine awareness of warning signals, disciplined risk management, emotional control, and strategic positioning are the ones who not only survive crashes, but often emerge stronger than before. The ultimate takeaway is simple. The market will always have ups and downs, but your response determines whether you lose, break even, or gain an advantage. By staying informed, prepared, and composed, you transform market crashes from threats into calculated opportunities, ensuring that volatility works for you instead of against you.